This is an Uncovered Japan Company research report on MiraiWorks, ticker 6563. It is a small Japanese matchmaker that connects experienced freelance consultants with companies tackling transformation projects. The business has grown revenue for 14 straight years, but its investment case turns on whether operating margins can recover after an expensive hiring cycle. At a share price of 494 yen in the report's source data, MiraiWorks was a 2.7 billion microcap with no debt and 1.45 billion yen of net cash. The headline forward PE was 7.1 times, but that rests on ambitious company guidance. The more important operating fact is a 25.5% gross margin. The company earns a spread for matching talent, then must turn that spread into operating profit. The product is straightforward. MiraiWorks wins a project from a client, matches a registered freelance professional to the work, and manages the contract. Typical engagements are high price, mid-duration consulting, or digital transformation assignments. Its pool had about 96,500 registered professionals, while 89 large enterprise accounts supplied repeat demand. The company is not selling inventory or owning heavy equipment. It is monetizing trusted matching and project administration. The top line has been remarkably consistent. Revenue rose from 4.9 billion yen in fiscal 2021 to 11.1 billion yen in fiscal 2025, a 22.7% compound annual rate. Profit tells a much less stable story. Operating profit reached 573 million yen in fiscal 2024, then fell to 284 million yen in fiscal 2025. The central research question is whether that decline reflects a damaged model or temporary underutilization of new hires. The report's key distinction is that gross profit still increased in fiscal 2025. The compression happened below gross profit, as selling, general, and administrative expense rose 17.2%, while revenue growth was far slower. More direct sales hires, advertising, and goodwill amortization pushed operating margin down to 2.55%. That makes the margin weak today, but it also means the underlying matching spread did not collapse. Reported net income was noisier still. Fiscal 2025 included a 93 million yen goodwill write-off related to AN Technologies and an elevated effective tax rate. The research, therefore, treats operating profit and normalized earnings as more informative than 1 year's reported net income. This is not a claim that the impairment is irrelevant. Rather, it separates recurring business economics from M&A-related accounting effects. The balance sheet protection comes from the asset-light structure. CapEx was just 5.7 million yen in fiscal 2025, and the company had no debt. The report expects free cash flow to improve if sales productivity catches up with the expanded cost base, but that is an analytical scenario rather than a guarantee. For investors, the practical point is that a thin operating margin is being tested in a business that does not need heavy capital to operate. MiraiWorks' closest thing to a moat is the combination of its accumulated supply base and enterprise demand relationships. A comparable pool of vetted senior professionals takes time and reputation to build, and repeat work within major accounts matters. But the moat should not be overstated. Freelancers can use multiple platforms. Individual project switching costs are low, and the business has only modest capital barriers. The network protects the existence of the spread. It does not assure a wider margin. Management's path is to turn the hiring investment into higher sales productivity. The company is using standardized sales tools and its owned media channels, while the smaller regional revitalization and solutions businesses provide additional option value from the same professional network. The report is deliberately cautious. The plan is coherent, but the productivity payback is unproven. The next earnings releases matter because they can show whether operating leverage has begun to reverse. Here, comparison provides useful discipline. MiraiWorks traded near the low end of the group on forward earnings, but its revenue growth and operating margin were also lower than faster-growing peers. In other words, this is not simply an overlooked multiple. The market is pricing real execution risk. The valuation becomes interesting only if sales productivity lifts margins without sacrificing the matching model's gross spread. The report's scenario range is intentionally wide. Its fiscal 2028 bear case is 204 yen, its base case 1,191 yen, and its bull case 2,644 yen versus the 494 yen source data price. These are the author's model outputs under stated assumptions, not price targets or a recommendation. The range is wide because both earnings and the valuation multiple depend heavily on whether operating margin recovers from roughly 2%. MiraiWorks is an asset-light professional talent matchmaker with a genuine network asset, no debt, and a long record of revenue growth. The trade-off is equally clear. Profitability is volatile, liquidity is thin, and the whole case depends on a margin recovery that has not yet been demonstrated. For the full evidence, assumptions, and risk discussion, read the free Uncovered Japan Deep Dive. For a much deeper look, visit the free deep dives at uncoveredjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.